Just got wrecked. Welcome back to Strongman Personal Finance. So we got to talk about Apple Incorporated, which just released earnings, and apparently nobody knows about this stock. Nobody does research on this stock. It only has the largest market capitalization in the world. It's only 3.66% of the Vanguard Total World Stock Market Index and probably double that in the US Total Market Index. But we still need to do analysis and potentially consider if we're going to buy this as an individual stock. Because if you buy a total market index like VT, you might as well also buy Apple on top of that to have a higher weighting than 3.66% of your entire portfolio, right? And yes, 3.66% of my entire portfolio is in this stock, even though I don't own it individually. So it's down 3.42% as of the time I'm making this video, and we got to find out why. So they reported their fourth quarter results, and basically things are so okay. They're not disastrous, but they're not amazing. They posted quarterly revenue of $89.5 billion, down 1% year over year, and quarterly earnings per diluted share of 1.46, up 13%. So revenue's down, basically flat, and earnings are up, probably because of increases in margins, okay? And they announced a dividend. Wow, that's amazing. Let's dive right into the financial statements. Now, the first thing that jumps out at you when you look at their condensed consolidated statements of operations, unaudited, is that their product revenue year over year has gone down. That's right, their product revenue, the freaking iPhones and iPads, actual products, have gone down by about $3 billion. That's pretty crazy, okay? That's what happens when we don't get stimmy checks anymore. But services revenue, Apple services, has gone up and basically almost compensated for that. Now, the second thing you may notice is that they divide their cost of sales between products and services. Their cost of sales their margins are a lot lower for their products. You can clearly see they collected 67 of revenue, or they accrued it at least, and they spent 42 billion of that on the product. So the difference between those two is the profit margin from that. Look at the difference between product margins and services margins. Service margins are way higher. So I think what some people like about Apple, like these analysts that, analyze Apple, because nobody else does it, of course. It's only the largest market cap in the world. They see the services growing, and the services have higher margins. And if you can project that services will continue to grow and grow and grow, then Apple can continue to grow profits, et cetera, et cetera, et cetera. So that's probably the bull case behind Apple. And maybe they'll do it. I don't know. It's not a bad company, okay? If you look at the 12 months, you can also see products is down and services has grown just a little bit. But overall, year over year, their revenue's down pretty decently if you compare 12 months to 12 months. Like I said, probably because we're coming off, stimmy cloud market highs. But overall, their gross margin has improved because of services. That's basically it. And we'll see if that continues. Research and development, they've spent a little bit more on R&D, but not a crazy amount more. And they've cut some selling general administrative expenses. Their operating income is up a little bit. Other income expense, immaterial, and their total profits have gone up. So that's a good thing, okay? You want the company to continue to grow profits. And on top of that, with profits growing, they've also bought back shares. That's right. So all of that leads to earnings per share increasing. Now, here's another interesting thing I saw. Where is all the sales growth happening? It's all happening in America. Yeah, America. Everywhere else, sales growth has dropped. Europe has dropped. Greater China has dropped. Japan has dropped. Basically, every other place in the world has declining sales except for the Americas. And the growth there really isn't that great. Okay. Net sales by category. iPhone is up a little bit. Mac is down massively. That is a massive decrease in Macs. I never liked the Mac anyway, okay? This is they're expensive. I hate the operating system. I've never liked Macs. I've always loved iPhones. Freaking love iPhones. Macs, not so much. So I'm kind of glad Mac sales are going down. iPads, they're okay. They're expensive, but if you have an iPhone, do you really need an iPad? Wearables is down a little bit, and obviously we know services have gone up. So basically, the iPhone and services have carried all the revenue of Apple. Everything else has seen pretty significant declines, which is pretty incredible. Now, I would love to see the margins for each one of these products individually, but they don't break it out like that. We go look at their balance sheet. We see they have a little bit more cash, a little bit more marketable securities. Receivables are up a little bit. No crazy changes in the balance sheet, or at least on the current assets side. Marketable securities, no change. Basically, I don't see any major red flags. Obviously, I think Apple's going to be okay. Okay. We go down to the shareholder equity section. So we see common stock and additional paid-in capital. Now, the funny thing is, that while they're buying back shares, we can see that they bought back shares and went from 15.9 to 15.5. The stockholders' equity has gone up. That's what I suspect is that's from stock-based compensation, which is increasing the equity account. Because when you buy back shares, that actually decreases equity. Okay, for common stock at least. We see an accumulated deficit. Now this shocked me. Okay, so an accumulated deficit means that over time, a company has recorded more losses than gains. The only other thing I can think of that would affect that is that if they buy back their shares, they retire them, and that reduces retained earnings. That is the only thing I can think of that would result in an accumulated deficit. It makes no sense to me why Apple, which is highly profitable, would have an accumulated deficit unless it was because of share buybacks. I saw that, I was like, what? There's no way they have an accumulated deficit. So I suspect this is affected by share buybacks, and this number right here, the common stock, is affected by stock-based compensation. Accumulated other comprehensive loss. So this is very special items that don't show up in the income statement. So you can see there's a change here, right? So they had some kind of loss. And there's only a couple things that fall into that category, like available for sale bonds, I'm trying to think of the CPA exam. Derivative cash flow hedges. There's like 4 or 5 things that skip the income statement. They don't show up on here. They do not show up on here. But they go straight to the balance sheet and they affect equity. And basically, I think the reasoning is that there's some items that are not really related to the core business that they just don't want to, I guess the accountant gods have decided don't need to show up on the income statement. But you need to pay attention to stuff like this because remember Silicon Valley Bank, okay? You can see companies that have massive unrealized losses on certain securities. I mean, I don't think Apple has that problem, but you can see that problem if you know where to look. So you want to look at every line on the freaking financial statements, okay? I'm curious what this is, but I'm not 100% sure. All right, we go to the statement of cash flows. So we can see operating cash flow has gone down year over year. What is that mostly due to? Let's see. Accounts payable. Okay, so it's just a timing issue. Basically, they just when accounts payable goes down on your balance sheet, you have to subtract it from the statement of cash flows because it's technically like a cash outflow. So changes in working capital, current assets, current liabilities will be adjusted for on the statement of cash flows because you're reconciling from the accrual basis of accounting, which doesn't necessarily care about cash, to the actual cash. So you have to add back non-cash expenses like depreciation and amortization. You add back stock-based compensation. Yes, you add back here. Okay, Joseph Carlson, you add it back here. Shut up. Another non-cash expense. And then you subtract or add working capital depending on changes in the balance sheet. All right, let's look at but yeah, basically the difference in operating cash flow was just paying bills. It's just a timing difference probably. Let's see, purchases of marketable securities. They're shoveling less money into marketable securities. Holy crap, that's loud. PP&E, they bought a little bit more than last year, but nothing crazy. Let's see the financing. So they've actually bought back less common stock. They spent less cash buying back common stock than they did the prior year. This year, for the past 12 months, they spent $77.5 billion buying back common stock, and they spent $15 billion paying dividends. So their dividend has gone up a little bit, the amount of cash spent on it, but the actual money they've been spending buying back common stock has gone down. Okay, but they are plowing, you like that? They're plowing a lot of cash into buying back common stock, which is why their earnings partially, or probably a big reason why their earnings per share is going up. So overall, I mean, I don't get why you would buy this company as an individual stock. It makes zero sense. I mean, people I don't think they understand that when you buy an ETF, you're actually buying the underlying companies. This is literally 3.66% of my portfolio. Why would I buy this stock individually? I mean, their product revenue's gone down. Their services have grown. That's freaking great. But, I mean, come on. It makes no freaking sense. But that's the earnings. I mean, kind of lackluster. It's not disastrous. But they have some major issues with the Mac and the iPad. Basically, the iPhone and services are carrying them. And if services can continue to grow, if it actually works out, they can continue to expand margins. 100%. That's probably the bull thesis. But their products looks like they've almost peaked. But, we'll see. All right, talk to you later. Cheers.